The American monetary system orchestrates the creation, circulation, and valuation of money, serving as the backbone of a $150 to $200 trillion economy. Since its formal establishment with the First Bank of the United States in 1791, the system has evolved from a patchwork of localized banking to a centralized framework managed by the Federal Reserve and supported by the U.S. Treasury. At its core, fractional reserve banking enables banks to create money through lending, driving economic activity while navigating challenges such as debt accumulation and market fluctuations. In January 2025, the money supply, measured as M2, stands at $21,560 billion, reflecting centuries of financial innovation and growth. This essay provides a clear, factual, and comprehensive analysis of the system's mechanics, tracing its historical development, detailing money creation and circulation, examining the roles of the Federal Reserve and U.S. Treasury, and exploring currency valuation and revenue generation. Historical milestones, from the first bank's standardized notes to the 1913 Federal Reserve Act and the 1971 shift to a fiat system, contextualize its evolution, while current data, such as the $45,560 billion federal debt in 2024, highlight its scale. The system's complexity, balancing economic growth with stability, makes it a vital engine for the nation's prosperity, and this narrative aims to demystify its operations for a broad audience. In the pre-1791 era, local banks issued notes backed by gold or silver, limited to community use and vulnerable to counterfeiting, constraining the money supply to $10 to $15 million. The first bank introduced fractional reserve banking, creating money through loans and fostering trust with uniform notes. The Federal Reserve, established in 1913, resolved the instability of the 1836 to 1913 period, standardizing currency and expanding the money supply to $20 billion by 1913. The 1971 transition to a fiat system, ending the gold standard at $35 per ounce, enabled flexibility for a globalized economy. Today, the Federal Reserve manages interest rates set at 4.75% to 5% in 2025 and bond purchases, supporting a $1,900 billion deficit. The U.S. Treasury prints currency, collects $5 trillion in taxes, and issues bonds, ensuring liquidity and stability. This essay explores these dynamics across 4 parts: historical development, money creation and circulation, institutional roles, and currency valuation with revenue generation, providing a comprehensive, engaging narrative of the system's operations.